Good morning, everyone. Today we will learn how income taxes are calculated. Please study the flowchart, and even after we're done, take time to review all the categories in the subsections. Let's start with gross income. Gross income is an individual's total personal income before taking taxes or deductions into account. Notice how this is calculated. Through wages, salaries, and tips on a W-2, maybe from a 1099 for a self-employed individual. You will also see a lot of unemployment compensation with the state of the economy, as well as individuals on Social Security. Next, let's take a look at deductions from gross income. These tax deductions are a reduction in the gross amount on which a tax is calculated. Notice business expenses, losses from sales or exchanges, or expenses of producing rental or royalty income. Next, you'll see the section of adjustments to income. Things like educator expenses for teachers, moving expenses for those changing jobs, IRA deductions, self-employed retirement plan contributions, tuition fees, and student loan interest deductions. These are all things that take away and reduce the tax liability of an individual. Next, you will see the familiar term adjusted gross income, commonly referred to as AGI. The adjusted gross income is a figure referring to the amount of income used to determine a taxpayer's total income tax liability. This is also where the generation of the figure and the term tax bracket comes into play from the adjusted gross income. Next, you'll see itemized or standard deduction. Itemized deduction is an eligible expense or allowance that individuals can report on their tax return to decrease their taxable income. Usually, you'll see these in the form of medical and dental expenses, charitable contributions such as tithing to the church, and even tax preparation fees are all things that can be listed as an itemized deduction. Next, you'll see exemptions, personal exemptions. Yes, you take these even outside of your typical W-4 exemptions. These are allowances used to reduce your taxable income. As you can see, the name of the game is trying to reduce the taxable income for your client to generate them the best possible refund. Typically, even if your client is single with no dependent, you will still see an exemption of one themselves on a standard 1040 or 1040A. Notice, next to exemptions, you'll still see taxpayer as one themselves, their spouse, or their dependents. All these areas combined equals taxable income. From there, as the diagram shows, once the taxable income is calculated, determine the amount of income tax from the tax tables or the tax rate schedules. Luckily for you, your software will do this for you. Then, you will subtract any income withheld from the W-2 or 1099. Then subtract any tax credits such as earned income credit, child care credit, child tax credit, adoption credit, education credit, elderly or disabled credit, retirement savings credit, foreign tax credit, and other credits. Please note, as of this year, a lot of tax credits will not be refundable, meaning they will not be dollar for dollar credits. A lot of credits this year will simply offset your client's tax liability. Then, add any other taxes such as self-employment tax, alternative minimum tax, any unreported FICA, or retirement plan contributions. The result is the tax refund or payment due. Please note that your software will make a lot of these calculations for you, but it's still very handy to know the inner workings of a tax return and how the refund was generated. Thank you, and stay tuned for our next lesson.